Right now, the most valuable companies on Earth are rushing to sell you their stock. To some, this is the opportunity of a lifetime. The doors to the next great technology boom are finally swinging open. But while the marketing invites you in, the people who built the technology are sprinting for the exit. In poker, an unconscious signal can betray a player's strongest hand or a desperate bluff. The stock market works the same way. You don't look at the news cycle or the earnings calls. You look at where the smart money is actually moving. While average investors buy into the noise, the professionals often move in the opposite direction. This is the reality of information asymmetry. In every trade, there is a buyer and a seller. When a company goes public, the insiders have access to internal data, cash burn rates, and structural problems the public will never see. The seller is the most informed person in the room, and the buyer is the least. These sellers aren't random. They are the founders, the early employees, and the venture capitalists who funded these operations when they were nothing. They understand these businesses better than anyone. They have looked at the numbers and made a decision. They would rather have your cash than their own shares. An open door in finance is rarely an act of generosity. It is a calculated trade, executed by people who have run the math and realized that selling to the public is the most profitable move they have left. This chart shows the massive bill forcing insiders to act. This year, tech companies spend $725 billion on AI. Spending $1 million every single day from the Roman Empire to today still wouldn't match what big tech spends in a single year. When you break that total down, the spending becomes even more staggering. That's $2 billion a day, $83 million an hour, or $23,000 every second. This massive velocity of spending creates a financial ticking clock. An infrastructure build-out at this scale leaves no room for error. It either generates immediate returns, measured in the trillions, or the capital requirements become unsustainable. This diagram compares that mountain of spending to what is actually coming back in. Over the past 12 months, the entire AI economy combined generated an estimated $110 billion in revenue. The industry is currently earning back an amount equal to roughly 15% of what big tech alone plans to spend this year. The gap is immense, and it is flashing bright red. Enterprise adoption numbers suggest why the revenue is lagging so far behind the hardware. While the actual companies spending real money to put artificial intelligence to work aren't seeing the profits required to pay the bills.
The utility of the technology is struggling to match the macroeconomic hype required to sustain it. The math breaks down even at the center of the boom. If any company should be proving the model works, it's OpenAI. OpenAI brought in roughly $13 billion in revenue last year, a figure that is immediately eclipsed by a projected net loss of $38.5 billion. They are burning cash nearly 3 times faster than they can collect it. Internal estimates suggest the bleeding will continue, with the company expecting to burn through well over $100 billion between now and 2029. Despite these fundamentals, the latest funding rounds value the company at $852 billion. That is more than 65 times its current revenue. The market has priced these companies as if the spending gap is already closed. They are priced for a future where every single bet pays off perfectly, which gives insiders a massive incentive to sell while optimism still blinds buyers to the math. This behavior is a dine and dash. It's the moment the smart money quietly gets up and walks out the door, right as the waiter brings the check. History shows that a sudden surge in companies rushing to go public is a pattern that appears immediately before nearly every major financial bubble pops. In 1999, the number of tech companies hitting the public market hit record levels. Retail investors bought in, convinced they were owning the digital future. Instead, the bubble popped. The NASDAQ crashed more than 75%, and trillions in wealth evaporated. In June of 2007, Blackstone co-founder Peter Peterson and his partner took their firm public while the market was hot. They walked away with billions in cash. Barely a year later, the financial crisis hit, and the stock plummeted roughly 90%. When markets are booming, insiders unload their risk onto the most optimistic buyers they can find. The moment the outlook dims, those initial public offerings simply stop. Financial insiders are often the first to see the signs of a correction, even while they maintain a confident public face. In the summer of 2007, Citigroup CEO Charles Prince was asked about the bank's exposure to risky lending. He famously admitted that when liquidity stopped, things would get complicated, but added, "As long as the music is playing, you've got to get up and dance." He wasn't saying the party would last. He was saying he would keep dancing as long as the money was flowing. It was a game of financial hot potato, and the only goal was to pass the risk to someone else before the music cut out. The current handoff of AI stock to the American public occurs while that $725 billion infrastructure gap continues to widen. By selling now, insiders exit at a valuation that assumes perfect success, effectively offloading the risk of a correction to the next buyer. You don't need a magic stopwatch to know when a bubble will burst.
You just need to read the room, look at the math, and make sure you aren't the last one dancing when the music stops.